Hello, everybody. Welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I am your host, Dr. Michael LoPiano. Wonderful to see you all once again. What an exciting pre-market period we are looking at here. Look at all this wobbledy-whoop all over the place. Seeing the price move around, spike up pretty early, and then come back down here now just a few minutes before opening. Certainly very exciting. We have a number of things to talk about today. Most of all, of course, this new post from Roaring Kitty that popped up on New Year's Day yesterday amid market closure. Thinking about what that means, reflecting on that in the context of what we've been talking about this week, possibly amid these other signals of technical reversal from Ryan Cohen, CEO of GameStop, and his TA team, talent acquisition team, ostensibly, and these associated posts. Thinking about that and also comparing that to some potentially meaningful information, some things that were noticed back at the beginning of December, right around the time I was deplatformed from Reddit. So we're going to be diving into that and thinking, especially today, about the topic of today's article. I should say the title of today's article, which is as you will see shortly. Yes, there it is in the video. It's in the video title also, right? The Roaring Kitty traps shorts again. Traps shorts again. So, of course, trap shorts again means that there has to have been some other instance in which this occurred. I'm going to break that down for us a bit today and think about the mechanics of what goes into that. As always, with these open interest newsletter breakdowns, you can find, if you're joining us for the first time, you can find the link to today's article down in the description if you're watching this on YouTube. If you're watching this video on X, the article is, of course, pinned to the top of my page. I do these analytics every day exclusively on GameStop and release these before market open. So definitely, if you want to stay up to date with where I'm thinking and what's going to happen with our approaching trading day, using up to the minute pre-market information for the given day, then definitely check out these articles. So yeah, right. We got this tweet here. We got this post from the Roaring Kitty of Dave Chappelle as Rick James, right? This perhaps Rick James, I should say, perhaps Dave Chappelle's most famous sketch from the Chappelle Show. In fact, the one that he said ended up driving him away from performing on Comedy Central, right? A lot of people would walk up to him with his kids and go, "I'm Rick James, bitch." And he said that was something that particularly irked him and caused him, I believe, to run away to Africa, something like that. But right, what exactly this means, right? Perhaps only the most skilled memeologists would be able to decipher. But what I do want to point out is that, right, this is our second consecutive week on a market close day where we get a Roaring Kitty X post. I mean, that's about as divorced from anything to do with GameStop or stocks that I think you could possibly come up with. And yet we're seeing price action indicative of bullish sentiment surrounding the release of these posts when the market is closed, right? How is Roaring Kitty, how could he possibly be driving what's going on here in the background? What's really moving the price by dropping tweets when the market is closed? Definitely raises some question marks. But what I wanted to point out, right, is what does this have to do? What could this have had to do with our price action yesterday? And what we saw yesterday, let's zoom in a bit here. Right, what we saw yesterday, you know, I talked about, I shouldn't say not yesterday, but on Tuesday, right? What I talked about is this possibility, something being set up in the technicals, possibly Ryan Cohen gesturing to our price action approaching a key technical level, a key moment for entry into a multi-day reverse in our price action. I had noted that our price had for several days been approaching the midline of our bullish regression channel, and that the price had held pretty strongly to that into and out of the past 3 trading days, not Tuesday included. But of course, there was some possibility based on the structure of our market maker gamma exposure data that if shorts decided they wanted to come out and dump some heavy short volume, they could push us down below this line, right? Which is also, you can see it here, right? Lining up with, it's slightly above our $32 call gamma, right? Heavy call gamma accumulation position. And I noted that while our price stays above 32, we're inclined toward trading within this kind of tight $32, $33 call gamma intensive hedging bracket. Keeps the price pinned right within this area, actually within kind of this area. It's kind of off the screen here. But also lends itself to a kind of slower grind up over time. That's not something that's super profitable for dealers. Dealers want to see the price generally close as close to max pain, right? This ideal profitability point. Of course, max pain itself is based just on open interest with an assumption that dealers are primarily short most of the contracts that they are exposed to, right? They are the primary counterparty in all options transactions, and the vast majority of options transactions are long options, which are structured in favor of whoever is dealing them, right? Options contracts are structured in favor of the writing party, which is what designated market makers typically are. So, right, when you go out and you're doing trades, you might think you're being paired with another trader somewhere, and sometimes you are, but really you're mostly doing a trade that is facilitated between you and liquidity provided via, what would you call this? Well, via a dynamic pricing model, right? You get quotes from the designated market maker, which is operating through your brokerage, right? Your brokerage has an agreement with the designated market maker. The designated market maker provides quotes. You go out, and so if you buy an options contract, you're really most of the time doing business with the designated market maker, not with other market participants, generally. So, right, they have optimum profitability points. Max pain is a way to represent this through open interest, right? Just what the contracts are that are out there on the board and what that says about where the greatest number of contracts would expire. But this doesn't take into account premiums. It doesn't take into account which premiums are going to be set well, at a higher premium in another sense, right? What contracts are going to be priced potentially at an overvalued quote. It doesn't take that into account. So typically, the more extrinsic value you see packed into a contract, the more opportunity it has to be overvalued. In the money options contracts, harder to do that because of how much intrinsic value is in the contract, how much of the contract's value is based on the price of the underlying. So you go in with a lot more risk when you're dealing with extrinsic contracts. Of course, retail buyers tend to like to buy, right? The primary options trading instrument for retail buyers tends to be single leg long options with short dated expiries and at strikes that are very far out of the money. So these three things make retail trades, on by and large, highly biased against the long party, against the buying party, right? If you had to pick three things that would damage the probability of your contract, of your trade ending up profitable, you would pick a long single leg option with a short-term expiry that is significantly out of the money, so that almost all of its value, or all of it's out of, if it's out of the money, all of its value is extrinsic value. None of it is based on the intrinsic worth of the shares to which that contract hypothetically maps, because the contract is out of the money. Okay, so what we saw here, right, we can see some incentive for dealers to move it under this 32 position. Now, we don't know that max pain, which is at $30, is necessarily what they're ideally looking at as a max profitability, but certainly somewhere below $32, considering how much call gamma exposure we had at that strike. Okay, so we had attempts to reclaim this, but of course we had a lot of shorting come in and push us through this level, right? So times that this was reclaimed, right? We had a lot of share volume kind of spike up. It did look like up to about 500,000, maybe as many as 600,000 shares were borrowed in the pre-market period and shorted throughout the day in order to affect the stock, as well as probably some selective order flow rerouting. So, for example, right, we can see here, take a look at our share data. Look, so 9:15, we're showing 800,000 shares. Right? Earlier in the day, right, 950,000. So some borrowing happened here. Some were returned. But 9:15, we're showing 800,000 shares available to borrow. 9:30, right after market open, all of a sudden we shoot down to 450,000, and these don't end up replaced. Right? These numbers go down. We don't see these shares. It doesn't look like these trades were settled, right? That any of these available shares became available once again later in the day, and this was certainly confirmed in overnight settlement data on January 1st. So settlement still happens even when the market is closed, right? So clearinghouses, settlement, all of that still happens even when the market is closed. So this data, shares available to borrow, you'll see these change even when the market is closed because of settlement updates. So January 1st comes along, and of course we see, well, these positions, they don't look to have been closed. They don't look to have been settled, right? It's not like, well, they were closed, but we didn't see them maybe settle until the 1st, so then the shares weren't returned to the pool until January 1st. No way, right? We didn't see this number go back up in our data. And it turns out, right, that we also saw some potentially some order flow rerouting. So we had some pretty definitive support here on top of the midline of our slightly more range-bound regression subchannel that served as a pretty important intraday bullish reversal point. So lower highs, stable lows. Okay, this can signal potential for a bearish move to the downside. This can happen. But what was interesting, right, is we got this huge volume candle, almost 200,000 shares pop up, and we got, we saw, just like we saw back during this heavy interventive shorting during the week following Thanksgiving, we saw some, what looks to me, very selective order flow rerouting. Big order. This was our biggest dark pool order on the day, almost $2 million. Come in 58,500 shares at 31:51 at 1:24 p.m. Eastern time. So right exactly when it looked like, right, there was some potential to reverse to the upside here. This was routed off exchange, right? This was routed out of the lit market. It was a big order, but right there, you're telling me there was somebody in the dark pool just sitting there with 58, just say, I want to buy exactly 58,500 shares. It's possible, right? But it just comes up as fishy, right? And so instead, we don't really see that. We don't really see this huge volume candle. We get, nothing, right? So on this level of volume, we had this move back to the upside, but all of a sudden, 200,000 shares in volume comes in right when we touch a key support point, and the price goes nowhere and then falls through the bottom. So some fishiness here, just like we saw back on the 4th of December, just before we got this Time U cover post from Rory and Kitty. I go into more detail in this. I go through this step by step and do a comparison of these two sections. As well as I include some of my snippets from my articles then, which I had published. I mean, this was the week I had a post taken down. My Monday post was taken down when I talked about this. And I mentioned that, right, hey, if shorts end up kind of manipulating us out of this paradigm, if they can, right? They can, right? Here's a bottom, right? It was around $27. They can push us out of this, but if they push us by these support points, it's going to send some pretty heavy oversold signals, and they're going to possibly be caught vulnerable to a dynamic reversal with their positions underwater. And what happened on 12/5 when they tried to do this? Push the price under $27 into the 26s, and that happened to be the day when that happened. That happened to be the day that I was indefinitely suspended without any particular reason. Not from Superstonk, where I published my post, but from Reddit altogether. And then a few hours after this, Rory and Kitty came in with the Time U cover tweet, and of course we exploded back to the upside, back into the 30s and the upper 20s range, leaving everybody who was short underwater in those positions. It was possible there was some covering, some hope that they could cover those positions at a lower price, but then, of course, earnings was very bullish on 1210, and there was not an at-the-market offering from Ryan Cohen. So there was this kind of 1-2 punch, which kept the Thanksgiving shorts unable to close out their positions in their attempts to continue to try to push us and intervene and introduce this linearity and batter the price down, right? Countermand this authentic and organic bullish sentiment in order to forcibly restructure our technical paradigm such as it would be construed and constructed and navigated via in such a way that would benefit lower closes and maybe something more range bound. It would kind of diminish the degree to which we were in this this bullish uptrend. So it looks like we might have gotten something like that, right? We might have gotten, right? We got this kind of signal from Ryan Cohen, which pointed out, hey, look, we're finding some support along this midline, right? 1, 2, 3 days, we found support along this midline. Okay, we've had some touches down here to the midline of this lower sub channel, but not quite this slip down here like we saw, right? A little quick touch. And we got that early, right? We got this quick touch and it got bought back up. But then later in the day, maybe via this selective order flow rerouting, maybe some additional interventive shorting, who knows? Hard to say exactly. This is speculation on my part. I don't have a crystal ball. But then all of a sudden, right, overnight, what do we get? Another Roaring Kitty tweet, a Roaring Kitty post that who knows if it actually stimulated, right, buying and algorithmic buying in these pools of share trading that nobody else can access. Like, I don't know exactly, right? Is this just all from like, Robinhood's overnight market? Like, this is very strange, right? What is Robinhood's overhead market necessarily being, reported to major brokerages and scanners about what the price is? I'm not sure. But in any case, we got a pretty big reversal where right back up to the midline of the channel, right over it, and then right back to the midline. So, right, everybody who entered into a short throughout the day here to push the price down, their positions are now underwater. And at the same time, right, where did that candle go? That candle reversed right at this historic line here, right? So this price level, this is where I marked this. This is where shorts started to enter into positions back when we had 2.3 million shares available to borrow on November 29th, the day after Thanksgiving, when we just careened off a ledge here, right, straight down for 2 full days from 31.5 all the way down to eventually 26, but right, touched down here when dipped below the 104-hour moving average. So right now with these positions, we could see this serving as something of a resistance here, even on our big kind of bullish days, right? These 3 peaks, only briefly on this third one, following, what was this following? This is the recovery. This was just prior to Jerome Powell's announcement before triple witching, right? We got up to this line, didn't quite make it on Roaring Kitty's time you covered, didn't quite make it on the bullish earnings news, only briefly extended past this line, actually double topped on it, right? Something like that. And mostly stayed close to it overnight prior to Powell's announcement. And then we stayed below it. But, right, what happened here with the, I should say, last week's TA team post on Twitter from Ryan Cohen, we touched a technical support line, this support line of our bullish regression channel, and then went all the way over a course of, let's see, 1, 2, 3, 4 trading days, reversed all the way to the top and found support this time twice now above that underwater line for the Thanksgiving short. So any short that entered into a position in order to shove the stock price down here, who stayed in their positions, and we do not have shares available to borrow back up to 2.3 million. It's sitting at around 400 or 450,000. So the vast majority of short positions, if not all of them that were entered into, after Thanksgiving, anywhere in here, any short position that was opened in this area that was not closed, right, is now underwater. We'll have to see what's going on price-wise during the day, right? I mean, there still are 400 to 450,000 short shares out there. Like, they can push the price down. Maybe they will, as like a kind of a desperation attempt to keep the price sort of pinned beneath 32. That is a thing they could do. But right, it does look like they're kind of running out of stuff to do to really push the price down. Right? Maybe we wait in here until the 54-hour moving average kind of comes up above this line, but it's getting kind of hard to keep, like, you enter into another, let's say you enter into another short position for 400,000 shares, and then you don't cover it. Like, you have to buy to close, like, unless you go out and you're creating all these orders, right, through ETFs, something like that. Maybe they have a way to do this, but the easy ways to keep the price suppressed seem to be evaporating. And we do look to be having some of these peculiar kind of unexplained buying events in the background, such as what we saw take place late in the day heading into last week's options expiry, 12/27 options expiry. So yeah, interesting to see what's going to happen here, but it does look like there are quite a few interventive shorts, right? These are institutions that wanted to see our technical paradigm change, and got thwarted, both by Roaring Kitty and by Ryan Cohen, not necessarily working together, but working synchronously, something like that, or working harmoniously toward their own interests and their interest in the company. They seem to have trapped quite a lot of short money in underwater positions here. So it'll be interesting to see what happens moving forward. This $35 test is definitely still on the table. I think there is, we've seen a bit of bearishness in the options market total, but it's been largely short calls, kind of betting on our current range. In terms of our max pain, we're looking constant. In terms of our gamma exposure setup, we're looking pretty much the same as what we've seen. So a bookended range at 30 and 35. Most of the call gamma attention shifted to the upper portion of this range. There's really a focus on 32. If the price can be sustained over $32, then we can move into this kind of bullish grind up to try to test the upper end of this range, possibly see a transformation of our paradigm. Who knows, right, what's going on in the background, but there any kind of attempts to keep the price pinned in this area, right? So bears, dealers probably want to see the price pinned in this 30.50 to 31.50 area. Of course, there isn't necessarily the hedging pressure to do that. So to keep the price pinned in this area, we've seen, or it looks like what they realize they have to do is invest in short volume. They have to short shares when this gets too close to 32, because once the price gets over 32, if organic trading sentiment pushes it over this level, or there's kind of this background buying pressure, then we move into this range where, okay, in a low volume situation, hedging currents kind of keep us going up and down and kind of ping-ponging back and forth between 32 and 33, right? We have a lot of call gamma exposure accumulated at these two positions. So hedging kind of picks up, puts down, picks up, puts down, and it keeps a very low volatility kind of pin type environment. It's sort of like a microcosm of what's going on at 30 and 35. So you've got 30 and 35 applying this pressure as you kind of get along this range. So then, you get hedging resistance as you move up towards 35, and as you go down, you get hedging support from 30. But then in the middle of the range, you've got this gravitation. Then if you get over 32, you kind of got some gravitation into the middle, right? If sentiment pushes you up towards 33, 33 offers some resistance, 32 offers some support, 32 up, right, sort of back and forth. 32.5 is kind of sticky. It's it's not quite textured in the same way that, say, what's below 32 is. So you're going to see on lower options volume a sort of a very low acceleration type moves. But if you do see an intensity of bullish sentiment, if bulls come out and just start slamming options contracts for some reason, then it can really push the price up. If it moves up through 33, then you've got 33 acting as a support. You move into this area, you could get something pretty dynamic, right? You get some pull from 34, pull from 35, something dynamic and quick that goes from 33 up and smacks up against 35 before then reversing back down. Now, looking at what I assume dealers would like to see, right? Like I said, dealers are going to want to see this because it means all of the call gamma here, throw that away, right? All of the contracts, all of those contracts that are open in this area, especially long contracts, that all money into dealer pockets. So with so many contracts open at 32, I think we're looking at over 6,000 for this week. That's not a crazy high number, but there's a big profitability difference, especially looking at the sort of puts that we have on the other side. There's a big profitability difference between a close at 32.50 and 31.50. Right? There's a lot of contracts. 6,000 is a fair number of contracts. That's a lot of premium. Same thing with 33, right? They're not going to want to see this stuff in the money. So, right, obviously, right, with max pain at 30, we can see why with the accumulation of contracts here, right? There's another 6,000 there, but you've got some puts to kind of cancel this out, depending on where they sold these contracts, because there haven't been, some of these 30s are older. They weren't open this week. We haven't had a lot of activity at that strike. Probably their ideal profitability point is somewhere in here, probably somewhere in this range based on what the premium values were. But definitely not a considerable amount above 30, 32. Seeing a nice zero on those 32s, I think would make dealers pretty happy. So I guess keep an eye out for the bag of tricks. We have seen some put to call GEX ratios kind of shifting a little bit more bearish. Lots of short trades from traders, short calls typically, right? But nothing that's really forecasting any kind of strong risk, serious risk for price collapse. So I think at this point, right, it's looking at, okay, what kind of tricks are dealers or bears or institutions going to try to pull out to keep the price contained, number one. And number two, I guess my question going into this is, when do we start to see, right? Are we going to see more of this kind of background buying activity, right? This may be settlement related buying activity that, maybe related to ETF settlement, like ETF FTD settlement, like Richard Newton and otherwise Category 42 have been thinking about for a long time here. Are we going to start to see overlapping windows, for example, of, Rex regulation extension 68, right? Margin call extension windows. Are those going to start to come due? Especially for some of these shorts maybe that are trapped in their Thanksgiving positions, right? Their post-Thanksgiving positions at 27 or 26. Is this start gonna, will this overlap with FTD settlement in the next couple weeks? And are these attempts to get the price pushed down that we saw, say, yesterday, right? Is this necessarily angling purely for dealer interests, or is this also, hey, we need to get the price down because our margin call requirements are going to be due, and this is actually much higher than we would like to. This requires us to go out and get a lot more liquidity, right? Bring our accounts up to balance, something like that. We FTD'd these for an ETF, but of course the price that we borrowed them at to settle these earlier positions in GameStop, so we wouldn't have to FTD GameStop, failed to deliver. Right now, the FTDs for these are much higher, right? Is something going on with that? Hard to say. I will note that the Rec 68 window, if say on 12.5, right? So something like let's head back up to the 4-hour chart here. So, right, we had a lot of shorts enter in all throughout here, right? There were shorts entering in here. I particularly wrote about this. We saw some tactical order flow rerouting. We saw 100 or 200,000 shares of short volume come in here, right? This is in the millions now, right? This is a lot of money come in here to push us through the support at the 104-hour moving average, right? We saw this kind of here. This was a little bit organic, but maybe a little bit of tactical shorting. But right, anybody who entered in here is super underwater and might have gotten margin called after after the time you cover, right? If they didn't cover these positions, which I don't know, anybody that entered into here didn't cover these positions. Anybody that entered in during this day, right? If you got caught in this time you cover pump and you entered here, your position's underwater, right? Your position's underwater. Maybe you thought, well, there's going to be this at the market offering that's going to happen with the earnings report, so it's going to dip down, right? I talked about the possibility of, if earnings was received bearishly, we could have been pushed down into this the 204-hour moving average. We did see puts start to accumulate in that area, so I wouldn't be surprised if there were a number of shorts who entered into these positions or didn't close these positions on the assumption that Ryan Cohen was going to come out and do an at the market offering, and that they would then be able to exit for an even bigger profit, maybe somewhere here around the 204-hour moving average. But that's not what we got. Earnings was surprisingly bullish. GME turned a profit in its third quarter. That hasn't happened in recent history. And at the same time, Ryan Cohen announced that the company had no intention for the remainder of the quarter to issue any more at the market offerings. So this completely shattered bearish expectations for what was going to occur out of this earnings period. We had a bullish day, and we did not get back down, right? We didn't even come close, right? We didn't get back down certainly into this range here. This would be the 12.3, 12.4, 12.5 range. These lows, we haven't been back there. Basically, I don't know, except for a pre-market second for, whatever is driving that, that's not enough time and that's not enough liquidity to cover, a 100 or a 200,000 share position. So these shorts got trapped. These shorts got trapped in here. Maybe they found some liquidity, I don't know, in here. But, this is also shorting, right? They try to use shorting to move the price down so that they can cover their older shorts. But then, it's this double down and short, double down, try to use organic bearish momentum or retrace momentum with tactical shorting to then get yourself in a better position to close your earlier shorts. And what it looks like to me is just maybe they kept betting on that type of stuff and just were not successful to push the price back into a range where they could exit those positions for a profit, certainly for no loss. So now what we're seeing is those shorts that entered back in 1129, they're underwater now too. And the shares available to borrow numbers are not going up. So somebody in here, right, if they got margin called, right, if these people got margin called, and they ask for an extension, they get 29 days plus holiday exemptions, right? They have 14 days, right? They have 15 days to meet capital requirements. Or no, it's 14 days, and then it's a 15-day Rec 68 extension with holiday exemptions. So we've had a couple holidays in there. We don't know exactly per FINRA what the actual holiday extension dates this year are. Otherwise, Category 42 has been checking some of this out. Reddit user and Twitter user, or I should say X user, author of the Big DD, who's put a nice graphical representation, very well organized graphical representation of this. So I'll link that in the description. But I mean, hey, if these guys got margin called in here, they're running out of time before they have to cover, and the situation's only getting worse, right? Where they got to bring If they don't, right, what is standard procedure, if they don't meet margin requirements, they will have to punch through a VWAP order, a volume weighted average price buy order, to cover their position, to cover their margin requirements, to bring their account back up into positive status, or they risk suspension from all trading activities, which is even worse than having to take a loss on that type of position. So yeah, so we will see here what happens. Interested to see what goes on with today's price action. Interested to see what goes on with Friday's price action, right? They may try to find a way to bottle some of this up to try to delay this to something on Friday. Maybe this is something that gets pushed into next week. I mean, if those, say, 12.5 shorts, if they got margin called with a Rec 68, and let's say the maximal holiday exemption was, I don't know, 3 days, maybe Christmas Eve, Christmas, and New Year's Day or something, maybe more. You're looking at 30, 32 days. So, we're looking at, I think it's right, the first trading day, if that falls on a weekend. So third would be the 10th. So yeah, like maybe something towards the end of next week, if those guys got margin called, is when we'd probably be expecting to see something like that. So I don't know. If they did get margin called, they're going to be running out of time. Interesting to think about, interesting to speculate about. We'll have to monitor the price action and see what goes down. So thank you everyone for watching and listening. As always, very, very interested to see what continues to develop here on GameStop. Stuff is looking good. Stuff is looking cool. Stuff is tasting pretty spicy, if I do say so myself. Yeah, we'll be back tomorrow, right, for tomorrow's video, and we'll be back to our weekly live streams tomorrow after market close. So hopefully we'll have some interesting topics to disclose there, and some interesting things to think about as we approach our prospective price action heading into the remainder of January. So thanks very much again. We'll good luck out there, and we'll see you guys next time. Thanks very much. Take care.